Every market has its line in the sand. For silver, that line is $50 an ounce. It was first touched in 1980 in the drama of the Hunt brothers' attempt to corner the market, and it came close again in 2011 during the fallout from the financial crisis. And now, in 2025, silver is back at the doorstep, surging more than 60% this year alone. The question is simple. What happens if silver finally breaks through $50? This year, silver has quietly outperformed almost everything, from less than $30 in January to over $47 an ounce today. It's up more than 60%. And that is faster than gold, faster than equities, faster than most commodities. Yet for all the excitement, silver has still not cleared its old high. 45 years of resistance, 45 years of waiting. Breaking it would not just be symbolic. It could mark a generational shift in how the market views this metal. So why now? Well, the answer lies in two powerful engines driving silver at the same time. The first engine is safe haven demand. With inflation still sticky, the dollar sliding, and geopolitical tensions running high, investors are once again looking for protection outside the system. Gold has already made new record highs this year, touching nearly $3,900 an ounce, and silver is following, but with a difference. Where gold could be argued to be a defensive play, silver is smaller and more explosive, and that is why silver can sometimes double or triple in the time it takes gold to move by a third. And right now, the safe haven case is being supercharged by the ongoing US government shutdown. And on the surface, it looks like just another political standoff in Washington. But the consequences, they're real. More than 750,000 federal employees face furlough, some without the prospect of back pay. That loss of income filters straight into consumer spending. Holiday retail, auto, travel, all the big discretionary categories that begin to feel the pinch. But the impact does not stop there. The shutdown also means no fresh economic data, non-farm payrolls, CPI, consumer surveys, the very reports the Federal Reserve depends on to make policy decisions are simply not being published. So in effect, the Fed is flying blind. And with its October meeting approaching, traders now assign a near 95% probability of a rate cut, simply because policymakers will err on the side of caution without reliable data. And the bond market has taken notice. Yields on the 2-year Treasury have dropped to 3.6%, while the 10-year sits just above 4.1%. That flattening curve is supportive of non-yielding assets like silver and gold. And with the dollar index slipping to multi-month lows, the tailwind for silver has only grown stronger. The lesson is straightforward. What starts as a political deadlock can cascade through households, corporate earnings, the bond market, and ultimately the currency itself. Investors know this, and that is why, as Washington stalls, silver is moving. The second engine is industrial demand. Solar panels, electric vehicles, semiconductors, and data centers are devouring more silver than ever before. And unlike jewelry or coins, these are not optional purchases. They are the building blocks of the energy transition and the digital economy. Demand is inelastic. It keeps rising regardless of price. Now, this matters because the supply side is not keeping up. For the 5th year in a row, the silver market is in deficit. Mining supply is constrained. Recycling cannot fill the gap, and industrial demand keeps growing. In 2025 alone, analysts project a shortfall of around 100 million ounces. So over the past 5 years, the cumulative deficit is closer to 800 million. That is metal consumed, gone, not replaced. Above ground stocks are shrinking. In London, where the world's largest silver vaults are located, holdings have fallen from over 1.1 billion ounces in 2021 to under 800 million today. And most of that metal is locked away in ETFs or large institutional accounts. Once you strip those holdings out, the available free float is closer to 150 million ounces. Now, at current demand levels, people are really starting to ask, is this enough? Now, this is not the same as saying the vaults are empty, something we spoke about last week. They are not. But it does not mean that the pool of silver that can actually be mobilized quickly is shrinking, and that has consequences. Borrowing costs for silver in London have spiked, futures spreads have widened, and arbitrage between New York and London has become unusually volatile. And these are all signs of potential stress in the system. So what does history tell us here? Well, whenever silver nears $50, people, they look back. In 1980, the Hunt brothers tried to corner the market. Prices exploded to nearly 50 before collapsing when regulators intervened. That episode was about speculation, leverage, and an artificial squeeze. In 2011, the move was different. The world was reeling from the financial crisis and trust in banks was thin. Central banks were printing and investors, well, they sought refuge. Silver climbed relentlessly until it peaked just below 50. Again, it corrected, but the drivers were structural: deficits, distrust, and demand. Now, today, the setup is more like 2011 than 1980. There's no corner, no single speculative frenzy. What we have instead is a slow grind of fundamentals, persistent deficits, industrial growth, safe haven flows, and a fragile financial backdrop. If silver breaks 50 this time, it will be against the weight of structural forces, not a speculative stunt. Now, on top of those two engines sits a political wildcard. In September, the US Geological Survey released a draft list of critical minerals, and for the first time, silver appeared on it. The designation is not final yet, but if approved later on this year, it would mark a fundamental shift in how policymakers view the white metal. Because until now, silver has been treated as a precious asset, a hedge, or a jewelry metal. This draft list treats it as something else: a strategic industrial material essential to national security and economic competitiveness. The reason is clear. Silver is indispensable in solar panels, electric vehicles, semiconductors, and even advanced defense technologies. And here is the vulnerability. The United States imports more than 70% of the silver it consumes, and much of the refining capacity sits in China. Meanwhile, major producers like Mexico and Peru are eyeing higher royalties and tighter regulation. Supply chains are becoming more politicized, and that is why policymakers are beginning to view silver less as a commodity and more as a strategic resource. If the proposal is finalised, it could open the door to government stockpiling, subsidies for domestic mining, and faster permitting for new projects. History shows that when governments classify a material as critical, it usually creates long-term demand support that goes beyond market cycles. Even in draft form, the signal is unmistakable. Silver is no longer being viewed purely as a poor man's gold. It is being recognised as a metal that the modern economy cannot function without. Of course, one of the most watched indicators in this space is the gold to silver ratio. How many ounces of silver it takes to buy 1 ounce of gold. Now, historically, silver has been cheap whenever the ratio is above 80, and right now it is hovering around 82. Analysts argue that a move back towards 60, a level seen in past bull markets, would imply much higher silver prices. If gold holds near 3,900, a ratio of 60 would put silver north of $65 an ounce. That is not a forecast, but it is a reminder of how silver tends to behave. It lags on gold on the way up and then suddenly overcompensates, sprinting ahead when momentum builds. And that is what happened in 2010 when silver doubled in less than a year. Breaking a round number matters in markets. Traders call it psychological resistance. For silver, 50 is not just resistance, it is the Everest of its price history. Every time it has been tested, the market has failed to climb past it. If it breaks this year or early next, the psychological release could be enormous. Investors who dismiss silver as a laggard may rush back in. Headlines would shout, new all-time high. ETFs could see surging inflows. Retail interest, which is surprisingly muted right now, could suddenly spike. And analysts already warn that once silver is above 50, momentum traders may push it rapidly towards 75 or even maybe 100. Now, of course, that might sound fanciful, but history, well, sometimes it suggests otherwise. Silver's small market size makes it uniquely vulnerable to parabolic moves. Gold's market is measured in trillions, but silver's is only about $30 billion a year. And that means even small changes in capital flows can have outsized effects. Now, none of this means silver will march in a straight line. There will be volatility, there will be corrections and false starts. In 2011, silver had a sharp pullback in January before rallying to its April peak. Analysts like Michael Oliver argued that this cycle will be similar: sharp jolts down, followed by even sharper moves up. The goal, he suggests, is to flush out nervous holders before the main surge. And this is why patience and perspective matter. If silver breaks 50, it does not mean it will stay above 50 every day thereafter, but it could mean that the floor of the market has shifted. Downswings might still come, but they could happen from a much higher base, and that is what analysts mean when they talk about a new price reality. Silver story is not just about charts. It is about the world we are living in, a world of fragile currencies, rising government debt, political dysfunction, and relentless demand for green technologies. A world where inflation is still a threat and central banks are cornered and trust in institutions is fraying. Gold has already responded, breaking to new highs, and silver is following, but with a twist. Its dual identity as both a monetary metal and an industrial one gives it a resilience and a potential explosiveness that gold does not always have. If silver does break 50, it will not simply be about investors chasing a headline. It will be about recognition that deficits matter, that industrial demand is unstoppable, and that silver deserves to be revalued for the era that we are entering. History says that when the real move begins, a breakout above 50 would mark the end of a 45-year consolidation. It would tell investors that the old highs are no longer ceilings, but floors. It would likely unleash new waves of demand, new scrutiny, and new opportunities, and it could propel silver not just into the 50s, but the 70s or even the hundreds. Of course, none of this is certain. Markets are never certain, but the conditions, the deficits, the industrial growth, safe haven flows, threatened dollar, political dysfunction have never been more aligned. The takeaway here is simple. Investors who wait for the vaults to be empty or for headlines to confirm the breakout may find that the real move has already passed them by. Silver is already in a position of structural tightness. The vaults may not be bare, but the accessible float is shrinking and the market signals are flashing red. 50 is not just a number, it is the threshold between silver's past and silver's potential future. And this time, if the barrier breaks, the move that follows may be one for the history books. Now, one last thing, as a special thank you for watching GoldCore TV, we are offering you a free strategy call. Book it in using the link below and make sure you let the team know that Jan Skoyles sent you. They're great and they'll walk you through the best options for owning gold and silver and answer any questions you might have.